Welcome to the Accumulating Wealth Podcast. I'm Hunter Satterfield.
And I'm Judson Crawford. We're CPAs, wealth advisors, and partners at Kane Waters and Associates, a financial services firm here to help business owners navigate the decisions they face every day.
Breaking news, Judson. The Internal Revenue Service announced the 2026 savings limits to 401ks and IRAs finally.
Well, they came back to work. Let's find out what they did.
Well, folks, we have been teasing limits for a while, but then the government was shut down, and of course they reopened, and boom, they dropped.
They were ready.
We are ready with our $500 button, but we're gonna do some fun first.
It's sort of a limited release.
Yeah, it is limited. More to come for sure. Well, Judson, I thought we'd start with sports betting because I know that we're both really big into sports. Not so much sports betting.
No.
But obviously there's a lot out there right now with the pitchers throwing the game, which just doesn't make sense. They threw a pitch for like $5,000. They made like $35 million over their contract, whatever. So I saw this stat, which was just staggering. The total amount wagered on sports in the U.S. in 2018 was $6 billion.
Okay.
Last year was $150 billion.
Good gravy.
Oh my goodness. I don't think this is good. This is probably not a good thing. And now we're going to let college football players gamble as well. It's a bad idea. For giggles, I was like, all right, Grok, tell me a country that has a GDP of 150 billion, because it's basically what was Morocco and Kuwait.
So we gambled Morocco.
Basically.
Got it.
Which, if you're going to gamble a country, I guess it's pretty good. Okay. I think we really need to go to RIP Penny Talk, right?
You know, we've talked about it before on the podcast, and frankly, I'm in full support.
It should. They actually probably got it from us because you were the one that said cancel the penny.
That's a good point.
That's right, folks. If you have not heard, the penny, which actually costs 5 cents to make, is officially done. President Trump earlier this year directed the Treasury Department to stop minting them. They are gone, which before I was coming on, I was talking about recording this, and then Scott Clench told me that the nickel costs 9 cents to make.
Doesn't make sense.
What
Just
are we
stop
doing?
the nickel too.
What are we doing? I have a great idea to balance the budget. This one's so simple, right? But I mean, and I think at this point, like, it's very rare. You and I talk about this all the time. Like, it's very rare. I have to like think ahead of time if I need tip money for places. Like if I'm going on a trip or we're going to a restaurant for a valet, I'm like, oh, I need to get some cash because they just don't have it, right? Certainly not carrying around pockets of pennies.
You know, I think the big loss is the take a penny jar. It will be gone.
Indeed.
You know,
Take a penny, leave a penny,
because I used to always take a penny and just throw it on the ground.
and then put some gum in there.
Yes.
You're that guy. That's why the penny's gone.
I'm the Costanza that takes the dollar that he in the tip jar that he just threw in there to make sure they see it.
That's right. Well, producer Aaron was thinking about this topic and found a great article. So we're going to talk about what some very popular chains are doing with no penny talk. So CBS News reached out to some of these. McDonald's has decided they're going to round totals to the nearest 5 cents. So, for instance, and this is not in favor of the customer. This is an interesting one to me. If their order comes at 10.22, which, by the way, couldn't they just round off their pricing to get rid of this? But whatever. Nobody actually said that. If their order comes at 10.22, then the customer will pay 10.20. If it's 10.23, it's 10.25.
Hey,
SOL, man.
There's gonna be some funny math going on.
Isn't there?
Hey, you know what though? Fountains are about to have their heyday.
Oh man, big time.
Yeah.
I need a penny. 10.22. I need 2 pennies and go run outside to the fountain.
Unis.
Oh, so
Up
good.
there, that's their time.
That's right. But down here, okay. So most of these companies, like Wendy's, is saying they're going to round down to the nearest nickel, but they're emphasizing digital orders and card payments. Blah blah blah. Go-To Foods, which owns Aunt Annie's, Cinnabon, Jamba Juice. Oh, it's just Jamba now. Excuse me. And Carvel, which I've never heard of for all the Georgia-based people, is recommending franchisees round cash transactions in the guest's favor.
That's nice.
Before I get to the worst
Right after they
offender,
raise prices 5 cents.
that's right. It's a good point. Before I get to the worst offender, apparently there's a convenience store chain somewhere in this company or country called Sheetz.
It's not the worst. I'm sorry, but there is a Colorado-based one that is the worst.
Yeah, and it's not Toot and Totem. No, it's don't even say it. I'm laughing right now. Do not say it, listeners. If you're interested, you can just go find it yourself. Okay,
Email Mason at KaneWaters.com.
Okay, the worst offender on this list. Holy cow! I can't stop laughing already. Is the grocery chain Kroger who has told CBS News that, quote, we kindly ask customers to consider providing exact change.
You know what?
There's no pennies
I'm
anymore.
going to grab out of the change bucket at home. I'm just going to grab and just start carrying around a whole pocket full of change
and
again.
sell them for 5 cents.
Yeah.
It's arbitrage opportunity. Okay, whatever. All right. So before we get to limits, folks, one more good. This is actually a serious topic.
Okay, ready?
Yeah, serious topic. Mortgages. So there's a lot out there in the news about 50-year mortgages. Trump also proposed, they're say that they're looking at maybe having like some sort of portable mortgage where you can take your mortgage and keep the terms and flip it to a new house, which I'm not even sure what that would look like, but that's out there too. There's an interesting thing kicking around out there also on builders mortgages. So basically what these are, folks, is that, when a developer is going to go build out a new neighborhood with a bunch of homes, they'll go out and actually buy a tranche of mortgages from a bank and then basically sell those to borrowers vis-a-vis like, hey, if you buy this house, we're going to give you a 399 mortgage in today's market. And so from that perspective, like you would think at first glance, oh, this is good. But the reality is that they're basically just upcharging you to make their money back on buying the bulk mortgage. They're going to upcharge you on the home, right? So if the home would normally have sold for $250, they might charge you $275, but then give you the 30-year mortgage. Now, at first glance, you might say, oh, well, who cares, Hunter? Because I'm getting a 30-year mortgage at $399 versus $625 on the open market, and that difference in P&I actually is a benefit to me. The problem with those things, and this is where everything always has strings attached, right? The problem with these mortgages is that, let's say you do agree to the higher price, guess what? The value didn't go up. So 1 year into this thing, if you're trying to sell it, you are going to be underwater on that mortgage immediately. So again, it's not always, sort of roses here when you start talking about this. You've really got to understand that if you take that lower mortgage, yes, your interest payment might be lower, but you also might be underwater from the get-go. So just super cautious when it comes to that. Now, Judson, moving on to the 50-year, which again, this isn't even approved. And if it was approved, we'd probably have a more robust conversation. I mean, just first glance, how do you look at the 50-year mortgage versus a 30-year?
I don't.
Okay. Second glance.
Look, I mean, if it's in theory, you are still building equity from the minute you buy. Okay, so that is a positive. I think that it would be something where if that allows you to get into a home, and then refinancing or paying it off more quickly, then I could see that being an option. I fear that what it would be used by is for people to get into a larger home that they just can't afford on a 30-year, which I don't think is what we're really going for here. What it's really meant to do would be to get people into a home more than anything. I ran the numbers really quickly long before we started the podcast. And if you take out a $500,000 mortgage at 5%, over a 30-year loan, the payment is $2,684. If you do that same thing, same rate over a 50-year mortgage, it is $2,270. You save $414 per month in rent. So that extra money, if you think about this, how much more are you actually paying for that? It's not the $400, right? It is the full $2,270 at 240 months or 20 years. That is $544,000.
Yes,
you're paying for the house over again.
It's not a financial win by any stretch. I mean, and I think the result would be home prices would obviously go higher just because people are able to spread that out. We have a supply shortage. That's the whole issue, right? And that's the problem. It's less so that people can't afford the monthly payment. And what we've said on here time and again is that if you can afford the down payment to get in the house, oftentimes you can afford a 30-year mortgage,
yes.
Right? So I don't think this 50-year mortgage thing is necessarily a win unless, again, this kind of goes on to the portable one as well. I could see a win for like, hey, if it's your first time to buy a home, you are coming with 20% down. We're going to give you a one-time option sponsored by the federal government of 50 years, and you're going to get, refinance out of that automatically after 5 years or something like that, to where it's like, hey, we're going to make it more affordable on the front end. But not everybody in America is going to go out and get some 50-year mortgage because that's going to just cause skyrocketing prices as well. I think that's the same thing on this portable mortgage thing, which again, basically, folks, what that means is you take your existing terms. So, Judson and I've talked humble brag before that we're locked in sub 3% for 30 years. And so you basically take that and you say, oh, I'm going to just transfer that to a new one. And while that might create some movement in the housing market, it is going to create some pricing problems as well. I saw somebody propose this, which I thought was really interesting, sort of like the military has for people that have been in one of the academies or have been in service, where it's like, hey, you get this one-time loan, it just drop to the floor rates, right? This one-time opportunity, and you can transfer it between people or whatever else it is. What about if it's a one-time? Like it's a, hey, you and I who have now owned a few homes in life, you don't get this right to transfer your portable mortgage. But if you're going from your first one to your second one, that might be a good idea. But providing that nationwide is probably a bad idea.
Yeah, it would create a lot of chaos.
That's right. So look, folks, if these things actually come, of course, we'll come with more detailed stuff. But a lot of clients are asking about our opinions on it. So there you go. We have opinions. All right, Judson. Limit time.
Are you ready?
Do you have your $500 button ready?
Yeah, I'm ready.
Except we don't really need it this year. Go.
Okay, so the IRS came out today, and basically they updated us with the 401k deferral limit and annual IRA limitation. So for 2023, if you are
23
for 2025, which is the year that we are in right now, the maximum deferral if you were under the age of 50 is $23,500. Hunter, what is it now?
For next year, it is going up to $24,500, which we might add, we kind of called.
We did.
But
2 hits of the $500 button.
That's right. They hit it twice, or maybe they like hit it and then they like tripped and accidentally hit it again. But $1,000, that's a big win.
It's a good, yeah.
Especially because they also increased the catch-up contribution from $7,500 to $8,000. So those of our listeners that might have a little bit more gray hair, a little wiser, that are over the age of 50, got a $1,500 increase overall. Judson, we just went through one of the nerdier technical meetings internally on Tuesday related to these catch-up contributions. And for those that remember, there's all these rules that, hey, next year it's got to be Roth, but they actually haven't defined those rules yet. And so once they're more defined, we'll come out with those things. But there's a chance, according to our ERISA attorneys, that maybe our business owners will be subject to that, but maybe not their spouses. That's going to make zero sense. So way more to come on that, folks. But at least we know the limits now have jumped 1,500, 1,000 for regular, 500 for catch-up.
All right, let's talk about individual retirement accounts, otherwise known as IRAs, or my favorite, IRA accounts.
Yeah.
No, IRAs. So in 2025, the individual limit was $7,000 for somebody that's under the age of 50. They used the button.
They did. Well, at least for that piece, they did.
For that piece.
Yeah. The other one makes no sense to me, but for that piece, 500.
Yep. So starting in 2026, the IRA contribution limit is $7,500. Now, this one's hard for me, guys. In an IRA, if you are over 50, they have always increased by increments of basically $500 on IRAs, but not this year. We have a new regime. The IRA contribution limit is an $1,100 increase over the regular IRA contribution limit.
Makes no sense.
So $1,100, you will be able to get $8,600 into your IRA if you were over the age of 50. Congratulations.
I'm so pissed off at this one because they're now doing the HSA thing where it's like, I have to sit there and look across at my client and go, I don't know what the HSA limit is this year because it's like $162.50. Yeah, it's so annoying.
It's a weird amount.
But yeah, I mean, look, at the end of the day, it's still increasing, which is important because the IRA one doesn't increase every year. And so being able to see an increase there is excellent. So already, folks, just on 401k deferrals, the base 401k deferral, which went up 1,000, and the IRA 500, you and your spouse together, $3,000 more in savings next year in tax deductions, which is pretty cool. We did neglect, Judson, to talk about the increase to profit sharing as well. So we talked about the deferral increase, went from 23.5 to 24.5. Now, the annual contribution limitation for the whole defined contribution plan has gone from 70 to 72. Okay, what the heck does that mean? So for our listeners that have been clients for a long time, you know there's deferral and then there's the employer contribution, which again, this year in 25 was 23,500 and 46,500. Add those together, 70,000. did that math in my head, Judson.
Pretty good.
That whole amount is going to 72,000, which means that profit sharing piece is also jumping 1,000. So net for most clients that are running a full plan, they're going to get $2,000 extra, even if they don't qualify under the catch up.
Yep.
So everything's increasing apparently. The last piece of profit sharing plans is also the annual compensation limit. So for listeners that have been clients for a long time, that's typically what you'll see on your payroll schedule, what you get paid W-2. This is the most amount that can be counted toward testing in a profit sharing plan. That has gone from 350 to 360, which we also called.
Did they come out with Social Security yet?
No,
I didn't think so.
I don't see it on my sheet here.
I remember when it was $250,000.
That's right. But the 360, we knew so much that we were already starting to kind of build payroll schedules on it. Kudos to us. Okay. The annual, for those that might have a defined benefit plan, that also increased, just like the increase day. This is like Christmas.
Huge.
Yeah. Annual benefit limitation under DB increased from 280 to 290. So an extra 10 there as well. Which
Just handing out free money.
Basically. Actually, you know what they really want? They want people to save.
Yeah, that's a good point.
How about that? But Judson, to your point, this is kind of a limited release. That's it. We don't really have anything else.
Yeah.
It's kind of lame.
We'll come at you when we get more.
But I mean, again, listeners, this came out an hour ago, and here we are with it. For those that might be interested in reading on all of the detail on this, as well as any retirement-related cost of living adjustments, take down a pen and paper right now. You can address yourself to IRS Notice 2025-67.
Or just go peruse the IRS website, irs.gov. Lots of good stuff out there.
That's right. You can just print it out and let your head fall asleep on it when you want to go to bed.
Well, you know what, Hunter?
What's that?
The best way to keep up with this is to hit subscribe. You never have to miss an episode, and you can always go back and catch up on the ones you missed. If you're enjoying the show, leave us a review. We really do want to hear what you have to say. Got a question, comment, or even an idea for a future episode? Reach out to us at kmotors.com/wealth. We read them, and yes, we actually reply. And if you want to learn more about what we do when we're not behind the mic, visit kmotors.com. We're helping over 3,400 clients across this country work towards their long-term financial goals. Thanks for listening to the Accumulating Wealth Podcast, and we'll see you next time.